All right, so let's go ahead and continue our discussion of the allocation of overhead costs using activity-based costing. So in the previous video, we really spent most of our time looking at a traditional costing environment where we were using a single plant-wide overhead rate for factory overhead application. And we said that that is going to be fairly simple to do. We also talked a little bit about departmental rates. Here we have a company that has identified, looks like 4 different activity cost pools. They only have 2 products, at least 2 products that we can see for sure. They have axles and they have steering wheels, but they've identified 4 major activity cost pools. That doesn't mean that these are the only 4 cost pools that they have, but these are the 4 significant cost pools they have. Okay, so purchasing dollars, storage dollars, machining dollars, and supervision dollars by way of salary are accumulated by the following cost drivers: number of purchase orders for materials, and you see the little arrow here going down to both axles and then another one over into steering wheels. The amount of square footage that is required is a cost driver for storage costs, and these are fairly large items, so it stands to reason that for this type of a company, storage could be a major consideration. When we talk about machining dollars, number of machine hours, you should be fairly used to this one. And then finally, supervising dollars, number of employees. Okay, and we have that for both of these departments. So, depending on the type of environment we have, we could have a company that has all of these same 4 costs. And if there were 8 costs, we could say that a company has all 8 of those costs. But here we're dealing with 1, 2, 3, 4. Now, for this company that has these 2 products, axles and steering wheels, these 4 activity cost pools are significant. We could have a completely different company that has all 4 of these, and potentially a couple of them are not going to be significant enough to be used in activity-based costing. So these are the 4 largest activity cost pools that this particular company has identified. Here we have essentially the exact same thing, except we have a different company. Now, we don't have any indicator here as to what these products are that the company's making, but this is a different company quite clearly. And this company has identified 1, 2, 3, 4, 5, 6, 7 types of costs or activity cost pools that are significant in their operations. And just as we did in the previous company, they identified the most appropriate cost driver. So even though we have the actual cost pool up here at the top, the dollar amounts that are in these cost pools are coming from the cost drivers. So when we look at here, let's look at one that's a little bit different. Inspecting and testing cost pool. Number of tests. Okay, that seems like a pretty good cost driver to me. Some businesses will have products that don't require very much inspecting at all. The product will be very, very simple. The inspection process is perhaps visual only. Other companies might have a product that deals with some type of electronics, those types of things, and they need to be able to power on. Looking at them visually is not going to work. So the inspecting process is a more significant activity cost pool. So it just kind of depends. It is important to understand that the use of activity-based costing is a complement to an existing job order or process cost system. So it's not a matter of, which should we use, job order, process, or activity-based costing. We're going to use a job order or a process cost system, and then we may use activity-based costing with either of these types of costing systems. Activity-based costing provides more information. Accuracy is the most important benefit that we get from activity-based costing. It's more complex, and it's not always appropriate. If the accuracy that we get from activity-based costing causes us to incur far more costs, and we get very little improvement in accuracy, then we don't need it. But sometimes companies do need it. So it says here that activity-based costing supplements, does not replace traditional either job order or process costing systems. Let's look at an example here dealing with the Atlas company, and they have two products. These are automotive anti-theft devices. One is called the boot, so it looks like something that goes on a wheel. And it says that this is a high volume item with sales totaling 25,000 units per year. And then the club, which is probably one of those things that you put on the steering wheel, low volume item with sales totaling 5,000 units per year. Now, for purposes of simplicity, we're going to say that each of these products requires exactly 1 hour of direct labor. And so with that in mind, we can say that the number of units is going to equal the number of hours required direct labor, and that the direct labor costs are $12 per unit. Expected annual manufacturing overhead or estimated annual manufacturing overhead is $900,000. And then, so we've got our direct labor here, our manufacturing overhead here, and then we have our direct materials, which are always going to just be applied based on cost. We have $40 per unit for the boot and $30 per unit for the club. So under a traditional costing model, we would do the exact same that we've always done, and this is not going to change with activity-based costing either. Direct materials are strictly $40 for the boot and $30 for the club. Direct labor is going to be $12 for each product because it just so happened that it took 1 hour to make each product. Okay, if it only took 30 minutes to make this one, we would put a 6 here. But they both take 1 hour, so direct labor costs are $12. Overhead is applied based on that single rate, $30 to each product. Why? Because it takes 1 hour to make them. And just to refresh our memory, predetermined overhead rate is $900,000 divided by the 30,000 direct labor hours. 20,000 of these direct labor hours are for the boot, and 30,000 of them are for the club. Okay, so we add these figures together, and we come up with a unit cost of $82 for the boot and $62 for the club. All right, what I want to do at this point in time, so that I don't forget this, and you should write this, you should do the exact same thing, is I just want to write these two figures down. Our total cost for the boot was $82, and our total cost for the club, $72. And that's really all I want to do right now. Okay, so let's see, there we go. All right, so keep those figures in mind. That's slide 14 if you're in one of the classes. So that was traditional costing, and we've got these 4 steps of activity-based costing. We've really gone over these already, so we're just going to go over these very, very quickly so that we understand that, exactly what it is we're doing. We've shown already that we have to identify major activities and allocate manufacturing overhead cost to cost pools. And then we also have to identify the cost driver with the strongest correlation to the cost in that pool. There are going to be other types of activity pools that we don't look at that are insignificant. And then even with the activity pools that we look at, there could be multiple cost drivers. We're going to look for the cost driver that basically causes the most cost when they say the strongest correlation here. Then, using a process called division, we're going to compute the overhead rate for each pool. These are based on estimates, right? And I'll show you how we're going to do that here in a second. It's fairly similar to what you already should know how to do. And then finally, we're going to assign overhead costs for each cost pool to products using the overhead rates as we begin our production process. So we talked earlier and we said that we've estimated manufacturing overhead at $900,000. This is very, very important. We've identified, looks like with this company, only 3 activity cost pools. Now, what we're saying here is that there could be any number of activities going on that incur costs. But for this company, we have 3 that are fairly significant. Okay? Could have been 6, could have been 4. In this case, it's 3. And we're going to allocate, even though this $900,000 here is for a lot of different activities that we're not seeing here, we're going to allocate this $900,000 among these 3 activity cost pools that we have identified. So $300,000 for setting up machines, $500,000 for machining, and $100,000 for inspecting. Okay? Further information. We estimate expected cost driver activity is that we're going to set up machines 1,500 times over the course of the year. Over the course of the year, we're going to have machining hours totaling 50,000. This is again as an estimate. And we estimate that we're going to have 2,000 inspections over the course of the year. All right, so with that in mind, we can do some math here. And we can say that we're going to have 1,500 setups. We estimated that cost at $300,000, basically 1/3 of estimated overhead. We do some quick math here. Let's make that smaller. Do some quick math here, and we can see how they came up with that. I'm not going to do all of these, but I want to just show you this one here. $300,000 divided by 1,500 setups gives us our $200 activity-based overhead rate per setup. Okay, and then we would do the exact same thing for machining to come up with $10 per machine hour, and inspecting $100,000 in estimated costs divided by 2,000 inspections is $50 per inspection. All right, so clearly, if we look at this, we have those same 3 activity cost pools here, the cost drivers that we identified on the previous slide, as well as the number of setups, number of machine hours, and the number of inspections. However, now we'll break down each one of these cost drivers per product. So of these 1,500 setups, the boot is getting 500 of them, and the club is getting 1,000. Now that's important. That's extremely important information, because if you recall, we're selling 5 times this product. We're estimating sales at 25,000 for the boot, only 5,000 for the club, and yet number of setups is 2-to-1, club to boot. So this is going to cause a massive shift in product cost for each of these 2 products. Machine hours, okay, there's more of them for the boot, but it's not 5 to 1, it's 1.5 to 1. And then inspections, it's 3 to 1 the other way. So let's see what happens. We've got a little breakdown here as to how we would apply these costs, and we say that, okay, based on our overhead allocation, we have $425,000 going to the boot and $475,000 to the club. Now that's not too terribly different than what we had before, perhaps, except, well, yes, it is, because before we were basing it strictly on volume. But notice, we're going to take the units produced, which is 25,000 for the boot and only 5,000 for the club, and we're going to divide this out, and we're going to say, okay, overhead cost allocation, 425 divided by 25. Let's just see here if I can bring this calculator back over. 425 divided by 25 is in fact $17 overhead cost per unit. And over here we have 475,000 divided by 5,000 units, $95 overhead cost. Okay? So we see that, and I wrote this down over here just so I could kind of be looking at it as we were going through this, and I hope you did the same. Under traditional costing, our cost of the boot is $82. That was with $30 being allocated to overhead. Now it's $17. So our product cost was $13 overstated with traditional costing. We're far more accurate here. What that essentially means is that we were trying to sell a high volume product for far too much money. When we have an overpriced product, we're going to have a hard time selling it. And that's exactly what we have going on here under traditional costing. Now we have more accurate costs. Over here, the club, kind of a bizarre situation. We were massively understated on product costs. So we might have ended up selling a whole lot of those boot products. The club products. We estimated 5,000 units being sold. Well, if we're $65 understated per unit, we might have sold a whole lot. And this is going to have a tremendously negative impact on earnings. So you can see now the use of activity-based costing produces far more accurate results. Far more accurate. $65 understated tells us right away we need to be using activity-based costing. If we don't, our product costs, especially for the club, are going to be far, far understated. So I just kind of want to tell you why this happens when we use activity-based costing. You know, low volume products often require, it says, more special handling. And this is true because we're not used to handling them. So we should expect to see exactly what we saw on the previous slide, that the overhead application is higher to low volume products. Okay, there's some fixed cost implications there. So it says assigning overhead using activity-based costing will usually increase the cost per unit of low volume products. And again, that is going to be true due to the fixed cost component of producing those products. Okay, this video is starting to get a little bit long, so let's cut this one off and we'll get another one started.